Greetings to everyone. Two interesting opportunities, technical analysis and fundamental analysis with our software. Well, we are at price levels for these two stocks, two very important stocks that are really, really worth keeping a close eye on because they could be excellent buy opportunities very soon. Follow me, let's take a look at them together. The first of the two stocks we're looking at is General Mills. Here we are on the weekly time frame. This stock has gone through a long downtrend, dropping from almost $91 to the current $46, and it's definitely a very interesting stock. Let's take a look using the software we usually use. Right now, the price to earnings ratio is well below 20, and based on the four parameters we typically use, cash flows, the Peter Lynch formula, economic value added, and view sales, the average fair value calculated across these four parameters is $74.20 per share. So at the moment, it seems to be very undervalued. It has consistent revenue and earnings, even if we look at in the last quarter, there was even an increase in earnings, which is a positive sign for the company's financial health. So overall, we see a good trend developing over time. The next earnings report, which investors and analysts are eagerly awaiting, will be released in December. Here too, let's take a quick look at the revenue figures, which have grown steadily and impressively from 15,750 to 19,000 over the span of 7 years, indicating consistent growth. It's also very interesting and noteworthy that the net operating income, also referred to as net income, is 2.9 billion, which is well over 10% of revenue, a ratio we typically look for in fundamental analysis as a sign of strong profitability. In general, the company's debt has remained more or less the same, showing stability in its financial obligations. It has predictable and reliable cash flows, and we can clearly see an improvement in both profit margin and return on equity, which are important indicators of financial performance and efficiency. If we use the qualitative scorecard from the forecaster, it tells us that this is not a company that could easily be copied, essentially. General Mills' extensive global distribution network and established relationships with major retailers, strong customer loyalty built over more than a century, and proprietary formulations for its brands create formidable barriers to entry. Replicating such scale and consumer trust would require years of investment and expertise. Essentially, we definitely have a company with a significant economic moat, a strong competitive advantage, and specialized know-how that are absolutely and completely impossible to replicate. And so this situation of recurring revenues and basic consumer goods also represents recurring and high-frequency household purchases. Although they are not based on contracts, revenue predictability is high thanks to brand loyalty and habitual purchasing behavior. So, in theory, this is a situation where debt does not cause concern. As we can see in the 5-year period ending in 2024, revenues and adjusted net profit have shown steady growth, with compound growth rates in the low to mid single digits. Still, it's steady, consistent, and reliable growth, and a scorecard rating of 9 out of 10, so it's a defensive company with good solid numbers, a historic, well-established company with 34,000 employees. Moreover, General Mills' brands are extremely widespread, well-known, and essentially guarantee recurring, predictable cash flows. So, it's definitely a very, very interesting stock to consider. Let's also take a closer look at how earnings since the beginning of the year have grown significantly, showing a clear upward trend, while the price has yet to start following the earnings trend. You know that we use this tool, this software, to compare the price with the earnings line, which helps us visualize the relationship between the company's market value and its actual financial performance over time. This approach allows us to make more informed decisions by seeing whether the stock price is keeping pace with the company's earnings growth, or if there is a gap that could present an opportunity. By analyzing these trends, we can better understand the potential for future growth and the overall stability of the investment. And generally, when the earnings line goes down, the price obviously tends to go down as well, because we've seen how fundamental analysis is reflected in technical analysis. In this case, earnings have once again returned to significant growth, but we still don't see a reaction in the price. So we wait, because surely, well, you can't say surely, but we are confident that prices could return. Then we use the market mood meter, which combines into a single indicator the speed with the whole moving average, the Wyckoff indicator, and the trend price oscillator. In this case, we see that it is obviously below the trigger, so we still don't have a clear signal of a rebound, even though we can see in the very last phase there's a first upward movement and we've gone below minus 50, so into a potentially oversold area. So I would wait on this chart, which I really like. I really like also from a technical analysis perspective, because here we are, this is the situation. The lows were these three, with the third one precisely validating the long-term upward trend line. We are far 50% away from the all-time highs, and we still don't have any bullish pattern setups. I would simply look for a bullish Japanese candlestick setup on the daily time frame to consider a buy on General Mills. Then let's look at a stock we've never examined before, Make My Trip Limited. Here we're in the travel sector, an interesting company, Here we are, an online travel agency selling travel products and solutions in India, the United States, Singapore, Malaysia, Thailand, the United Arab Emirates, Peru, Colombia, in short, more or less everywhere. Airline tickets, hotels, packages, tickets, buses. In short, the core business is definitely clear. The stock has, if we look at the news forecaster section, which provides updates and forecasts about company performance, here we are reviewing the latest information. We take it from the Zacks Investment Research website, a reputable source known for its detailed financial analysis and stock market insights. In fact, let's translate it for clarity. It reported a quarterly profit of 37 cents per share. This means that for every share owned, the company earned 37 cents during the last quarter. However, this profit was lower than what analysts had anticipated, suggesting the company did not meet the expected performance for this period. To the 0.45, but 0.37 is higher than the 36 cents from a year ago. And if we read through everything, let's take a look for a moment. Here we are. What we see is that the quarterly report shows a negative earnings surprise of 17%. It was expected that this online travel company would report earnings of 45 cents per share, but instead it made 42 cents per share compared to 45. So there was a period of weakness compared to this situation of analyst expectation. So this has led to another significant phase of uncertainty, a period where things remain unclear regarding the recent price movement, but when viewed from a long-term perspective, this has not significantly affected the underlying trend. In fact, let's now take a closer look at the current fundamental data situation. Here we are, we have fundamental data that over the last 2 years shows improvements in both revenue and profits. And if we look back in March, there was definitely an interesting situation. Over the past 7 years, we've seen revenue grow from $675 to $978 million, and we have a post-tax operating margin that is exactly 10%, almost precise. So we don't have any sensational data, but we do have some interesting figures. In this case, it's difficult to evaluate the stock using the forecaster's parameters. And what I find interesting is that the stock has a decent profit margin, a ROE that keeps up with inflation, and it's a company with no debt. This is definitely an interesting point. If we use the forecaster's artificial intelligence to take a look at the quarterly report situation. By the way, I always remind you that we have a discount to subscribe to Forecaster, a 20% discount. You'll find the link in the description. Here we are at the latest earnings call. Well, the situation is definitely interesting. There have been noticeable improvements without a doubt, and in fact, we're about to see them for ourselves very soon. Here we are. Operating profit increased by 18% year over year, international revenue growth was nearly 30%, and hotel revenues grew by over 42%. Let's always remember that there's a big difference between revenue and profit. On the negative side, there was the issue of domestic routes. Growth in the domestic air market was slow due to supply constraints, which impacted overall passenger growth, and there was a quarterly loss of 5.7 million due to interest and exchange rate costs. However, overall, here we have a situation with mixed data. Despite the difficulties in the domestic air market and the loss recorded due to accounting items, the company has shown solid growth in international segments and an adjusted operating profit. Now, here we are dealing with a company that clearly doesn't seem to be super outstanding, but if we look at the overview, at the big picture, it has experienced interesting medium-term growth and is now going through a notable retracement phase. We've seen the latest quarterly report showing improving figures, and in this case, in my opinion, the chart is what should guide us the most. So let's focus a bit more on that. Let's focus on technical analysis, and here we are with McMetrip. I wrote that a buy hypothesis could be considered at the test of the $72 area. We saw a break of this support area, so in my opinion, we can expect a second exhaustive leg down, a crash. Here we're on the daily time frame, okay? The bearish movement, the attempt at a pullback on this area, which then clearly became resistance, and now it's pulling back again. I believe this level could be a very interesting area. If we look at it on the line chart, we can clearly see how this is a swing area. So we'll put it on the watch list because when it tests $72, we'll see if the support area holds, and if it bounces, I'll consider a buy. The underlying trend is definitely bullish, but between tariffs and the macro situation, the stock has suffered, dropping from $120 to the current $77. In my opinion, $72 becomes interesting. Take advantage of the discount we have for subscribing to Forecaster. Greetings to everyone. Happy trading. See you next time.